when we get ice cream as a family, my children are typically not happy when I take my dad tax bite out of their ice cream. They would much prefer if I got ice cream for myself and not take their dad tax. But sometimes I do either way, whether they like it or not. And as we think about ways to give charitably, a qualified charitable distribution is a way for us to give charitably without the federal government taking their dad tax. So Spencer, would you walk us through what a qualified charitable distribution is?
Yeah, so a qualified charitable distribution essentially is a way that you can take a distribution from your IRA, but instead of it coming to your bank account or credit union account, you push it directly from the institution that holds the funds to the receiving charitable institution.
Okay.
Now, it needs to be a charitable institution. It can't be, your son or daughter or somebody else that you just wanted to give some money to. It has to be a charitable institution that's recognized. But it goes directly there, and there's some really nice tax benefits that we see oftentimes from doing this qualified charitable distribution.
Okay, great. So what are some of the ins and outs of a qualified charitable distribution? What do we need to have? What kind of account? How does it work?
Yeah, so it has to be an IRA, an individual retirement account. This cannot be a 401k or 403b or 457 plan. It can't be another employer-sponsored retirement plan. It has to be that IRA. If we think about it, the federal government has been giving tax benefits to folks to save towards retirement through their working years. So if you put resources typically into a 401k or 457, 403b, traditional IRA, you're not paying taxes as the resources are going in. You get to defer taxation on that income that you put in there until down the road. You're deferring all the gains on those investments, hopefully over time. And then when you pull them out, you're paying tax.
Okay.
So when you pull those resources out, the federal government says, okay, time to pay us in tax. Now, they go to the point even of requiring you to take a distribution when you attain the age of 72 typically, because they want you to take the distribution and pay them in tax. They want to take that dad bite, that dad tax out of the ice cream cone. So the qualified charitable distribution allows you to get around that in a legal way and push those resources directly to the charitable institution. And there's different ways that you can do that. So one of the ways that we'll get into later is that you can actually set up at many institutions, you can set up a checkbook where you can write checks from your IRA and give those to a charitable institution that then can receive those resources.
That's helpful. So essentially you're saying that if my child, instead of taking the ice cream for themselves, they give it to a friend, then I feel bad about taking the dad tax bite because I can't steal from my daughter's friend.
Okay. It's one thing to take it from your own child, but to take it from the charity, from the poor, not even the government, will do that apparently.
Okay.
So that's why we want to use that qualified charitable distribution, because it's never recognized as income to you.
Right.
It's not something that runs through your typical itemized deduction. Instead, that income just never shows up for you. Instead, those resources go straight to the charitable institution, but it still can count towards you performing your required minimum distribution once you attain the age of 72 or older.
Okay. So let's walk through some examples of things that we have here about just how a qualified charitable distribution can help a client out.
Now, if Lyle wants to give a tithe of $10,000 to his local church, then he'll need income of roughly $13,158 pre-tax so that he can then pay the federal government $3,158, leaving him $10,000 after tax to donate to his church. Now, what if the situation's the same, but Lionel is 70 and a half and he had funds in a traditional IRA that he was withdrawing at any rate? Lionel could then request that his IRA distribute, instead of that $13,158 to himself, which he would then turn around and use some of those funds to pay the federal government. Instead, he could request that the IRA distribute a $10,000 gift directly to his church. In this situation, rather than the funds being distributed to Lionel, which would incur taxation, the dad tax bite of ice cream that we've been talking about, The funds can go directly to his church for $10,000, and they're actually not included in his taxable ordinary income. It doesn't show up there. In some circumstances, this can also reduce the income enough so that it can reduce or eliminate Medicare surcharges, which is another area of benefit.
Spencer, thanks for walking us through those situations. So we've gone over what is a QCD. We've gone over some of the benefits of it. What are the next steps in doing QCDs and maybe some important details about them?
Well, each financial institution is going to have its own ways that it can put together that qualified charitable distribution. Many, as I mentioned earlier, have check writing capabilities. So you can actually write a check. We think that that's preferable in many ways, pushing that out and you distributing that or giving that to the charitable institution, because typically your name and address will be on there, and that helps with record keeping. So one of the things that you also want to be aware of is when you make that qualified charitable distribution to an institution, you need to keep the receipt that they will give you for your tax filing. So you need to have that in hand prior to filing taxes there. Another thing that we want to share is that you can, per person, make a qualified charitable distribution of up to $100,000 per year. Another thing we want to surface is if you set up check writing on your IRA and you use that method of pushing out those qualified charitable distributions, it's our counsel that you make sure that you try to do that early enough in the year that the institution receives it and deposits it.
Yep.
Because our experience has been that the receiving institution, if they push out a check, they're going to know that that's happening and they can count that towards that particular year. If they are only receiving a check and then recognizing that check as the funds leave, then that needs to happen. That whole thing needs to happen prior to the end of the year. So oftentimes we'll say, write the checks, get them done by the end of November, get them to the institutions and follow up to make sure that they make the deposit as soon as they can.
Got it.
You don't want to do this at the 11th hour. This is not something that you send a check and it's in the mail by December 31st and you can count it that way. We don't want to see clients get to a point where their required minimum distribution wasn't fulfilled because it wasn't counted in that particular year. So something to be cognizant of if you are using check writing for that. One other thing is that you want to make your qualified charitable distributions all prior to ultimately fulfilling your required minimum distribution. So we don't want to see a circumstance where a client takes out funds, fulfills that RMD, and then gets to the very end of the year and says, oh, I want to make a qualified charitable distribution. The IRS has said that's a no-no. So make those QCDs, give the funds early. We've never come across a charity that said, oh, it's too bad that you gave in January. We wish you gave those funds in December to us.
All right, Spencer, any last things about qualified charitable distributions before we end out today?
Yeah, one of the last things is we want to make sure that you know, as you receive the tax forms in the mail at year end, and by the end of January, typically in the year after that you made the qualified charitable distribution, the institution is going to push out that 1099-R, the tax form, and it's not going to say that you gave funds to a charitable institution. It's just going to show the distribution.
Okay.
So what you need to keep track of is how much you've given to charitable institutions of that amount. And when you file your taxes, if you're working with your CPA or tax preparer, you want to make sure that that person knows that you've made those gifts, because there's the 1040 you have line 4 typically is the first part of that line says the overall distribution from your IRA. So you would put one number there, and then the taxable amount is right next to that. So it's typically 4B on that 1040. And what you would do there is you would recognize that it's a lower amount than the overall amount. So the taxable amount should be lower. And then typically CPA will put QCD right next to that to kind of let the IRS know that the discrepancy there is based on a qualified charitable distribution. Now, again, your tax preparer or CPA could have a different way that they go about those things. Don't take anything that we've said here as tax counsel. We do not prepare tax returns, but we have seen many good CPAs prepare things in that direction. And so, as always, we appreciate you following along in this journey with us, and we'll look forward to seeing you next time.
This content was provided by Retirement Planning Services. We're in Knoxville, Tennessee, and you can visit our website at www.seriousretirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents.